Good afternoon, everybody. Welcome to the fourth quarter economic update call. I'm Greg Sweeney. I am up to my old tricks. I have a number of slides to share with you today, and fair warning in advance, the number of slides I have probably means that we go a little bit beyond our 15-minute targeted time range for these conference calls. First item on the agenda is the government shutdown. As you might expect, it's a big deal. It's in the news. There are employees of the federal government, military service, all sorts of folks that rely on a paycheck coming from them, and right now they have been suspended. So definitely hardships for some of those folks. On the other hand, there's a section of folks out there, the markets specifically is what I'm speaking to, that don't even know the government is shut down. The stock market continues to touch on record highs, and the bond market really doesn't show any indication of what we call flight to quality or nervousness in the investor market, where they buy up U.S. Treasuries in defense of things that might be coming down the road. What's the big riff about on when we're talking about a government shutdown? It is the debt. Overall federal debt is about $37.5 trillion. A popular way to measure that is against our gross domestic product, or GDP, what we produce every year, which is about $30.5 trillion. This is a relatively new development in the wake of the pandemic, where our debt has skyrocketed above the GDP of the United States. And as a matter of fact, where the United States stands today in terms of overall debt to GDP, we are in the top 5 in the world. So not exactly a spot that we would like to be in. Fed funds. This is the interest rate, the short-term interest rate you hear all about on the news. It's the rate that the Federal Reserve sets to make monetary policy, lending, borrowing more accommodative or less accommodative. Lots of discussions on where the Fed's going to go, where it's going to land. The current administration puts a lot of pressure on the Federal Reserve to push interest rates lower in an effort to make credit easier to obtain. I do want to mention, though, that the pressure that the administration is putting on the Federal Reserve is nothing new. We just hear more about it today because of the way the news media works, but this goes all the way back to Lyndon B. Johnson and Nixon and things like that, where there's actually reported physical altercations in the Oval Office between the president and the Federal Reserve chairman of many years past. So it's not new, but falls into the category of being uncalled for, but it does make things awkward. So the Federal Reserve, there's a lot of energy that goes into predicting where the Fed funds rate might go. The one indicator that I look at in terms of where the Fed funds rate might go is the 2-year Treasury. The historical relationship between the 2-year Treasury and the Fed funds rate has a significant correlation. But it's a blunt tool, blunt in the sense that we don't know when the Fed is going to make it to the Fed funds rate indicated by the 2-year Treasury. We just know it sometime in the next 2 years. So that's the market's way of telling us where they expect the Federal Reserve to be going without making any guesses as to when they might get there. And right now it looks like the Fed is heading towards about a 3.5% Fed funds rate. Maybe even the next step later this month, going down to 3.75 to 4% range on its way to perhaps, like I said, 3.5%. What is the Fed worried about? Because one could make a really strong argument that the Fed doesn't have to cut interest rates at all. I mean, the stock market's at record high, Bitcoin's at or near record high, gold is at a record high, silver's at a record high, housing prices are at or near a record high, and inflation is at 2.9%, which is above the Fed's target of 2%. So all those items I just listed would argue that the Fed shouldn't be lowering interest rates, because making monetary policy even easier suggests that there will be even more upward pressure on all those items that I just visited about. What I think the Fed is really looking at is employment. Our total employment, we've never had more people employed, 163.4 million people. But I think what the Fed is really looking at is what we call non-farm payroll jobs being created. It's been on a downward trajectory. You may have recalled in the last couple months we had a big revision to the jobs reported over the last 12 months. Those revisions are fairly normal. This one was a little bit larger than normal, but there's always a revision to job reports, which are done through surveys once they compare actual records to state tax data. So that's where that correction comes from when they make those changes. But back to the topic at hand here, non-farm payroll, the most recent month showed that we added 20,000 jobs. I think that's what the Fed is looking at when it's concerned about the Fed funds rate level and why they might be on making a decrease here in the next 2 weeks now or so. The next page shows us the number of jobs that are open versus the number of people unemployed. It wasn't too long ago where we had about 4 million people unemployed and about 12 million job openings. Since then, that has changed significantly. We have a little bit more than 4 million people unemployed, and we have job openings somewhere in the range of 7 million. So what used to be 3 to 1 is now less than 2 to 1. So jobs are harder to come by. I would say my observation in the corporate world or business world is they're low to fire people, but they're also low to hire. So not a lot of new hires, but not a lot of people being laid off either. So this job openings versus the unemployment gives us some idea that jobs are getting more difficult to find. There's always a certain amount of unemployment and there's always a certain amount of job openings for various reasons. You know, maybe there's a geographic separation between where the jobs are and where the people are located. Maybe it's an educational difference. Maybe people are in school or whatever the case may be, retraining, right? There's always some sort of gap, but it has been narrowing, and that's what we think the Fed is looking at in terms of when it considers lowering the Fed funds rate. Labor force participation rate, this is the number of people that are age 16 to 65, considered working age, that are participating in the workforce, is drifting lower, meaning we really don't need as many jobs if that continues to drift lower. Of course, if it does drift higher, we might be questioning the ability of those folks to be able to enter the job market with the decrease in job openings as we saw on the previous page. Inflation, I mentioned that inflation is above the Fed's target rate of 2%. You've heard me mention in the past that I question the Fed's ability to get the inflation rate down to 2%. The long-term average rate of inflation is closer to 4%. Currently we're at 2.9% inflation rate. One of the reasons that would argue for the Fed not to reduce interest rates, because by reducing interest rates it can also stimulate upward pressure on inflation. But that number is currently 2.9%. Just a side note there, earlier this year, April, I think they refer to it as Liberation Day. It's just when the tariffs are going to start to be implemented. The tariffs, there was a big concern that tariffs would lend to significantly rising inflation rates. It hasn't since then. Matter of fact, the inflation rate hasn't gone up very much at all since the tariffs have been announced. And the reason for that is, if you're looking for an explanation, is goods only make up about 25% of the consumer price index. So if the goods prices do in fact go up and are all absorbed by the consumer, which the other argument is, it could be absorbed by the producer, the manufacturer, intermediaries along the way, and not all the price increases make it all the way to the consumer. The fact of the matter is the goods only make up about 25% of GDP, and its impact, even if the prices do go up, are minimized because of that allocation in GDP. Tariffs, you've heard a lot about tariffs, and if tariffs promote rising inflation and they hurt the consumer, why in the world do we use them? I think a perspective would be interesting for you all to see. This slide shows us what the other countries use as tariffs around the world. This was before we implemented our increase in tariffs, and the United States, in terms of developed nations, was one of the countries with the lowest tariff import rates. It's just about 3.75% or so. Our major trading partners are China, Mexico, and Canada. And you'll see that China's tariffs are for goods going into their country about 8%. Mexico just slightly behind that, call it about 7%. I wasn't able to pick up Canada from this World Trade Organization report that you're seeing on the screen right now. But why are we doing it? And the trade deficit is a real strong indicator of why we are implementing tariffs. This is our trade deficit. This is the amount of goods we import compared to the amount of goods that we export. We've been running a trade deficit since all the way back to 1990. Now, the topic trade deficit sounds a little benign, but what if I what if I renamed this and said this is jobs lost, these are industries lost, this is our economy being lost to other producers around the globe? It doesn't sound as benign when that number is negative. The idea of a trade deficit is we export a certain number of goods, we import a certain number of goods, and over time, hopefully it equals out to zero. So we're exporting as much as we're importing. You can see that has not been the case for many years, all the way back to 1990. Matter of fact, the cumulative value of this trade deficit you're looking on the screen here is $16.5 trillion. That's $16.5 trillion of production that went to some other countries, and the United States didn't do it. So our economy would have been much bigger without this trade deficit. Long story short, this is what tariffs is trying to address, is they're trying to right this ship a little bit. When we calculate gross domestic product, or GDP, the formula for that is about 2/3 of it is us as a consumer. About 17% of it is about business investment, so businesses investing in property, plant, and equipment. Historically speaking, the other 17% was government, and the trade deficit would be somewhere around zero. So anything we import in excess of exporting, it's a deduct, right? Because that was GDP produced outside the United States in some other country. Today, those numbers, two of those numbers look the same. One of them is consumer, still about 2/3 of GDP. Business investment is still about 17% of GDP. Government spending, though, on the other hand, is 23% of GDP. And those of you quick at math, you're going to say, hey, Greg, that doesn't equal 100%, it's 106%. That is correct. The trade deficit is about a 5 to 6% deduct from our GDP because of the amount of goods that we import into the United States. So the purpose for the tariffs, kind of on Paul Harvey's rest of the story, is to hopefully address this huge trade deficit and make it go somewhere closer to zero. 10-year Treasury bond rates, I mentioned that the stock market and the bond market appear to be the two places where they don't understand the government's closed. There doesn't seem to be any fear. There hasn't been a what we call flight to quality for the Treasury market. The 10-year is at 403. I do want to spend just a minute here and talk about, there's an understanding that if the Federal Reserve cuts short-term rates, that long-term rates will go down also. I want to dispel that and have you look at this graph that we have on the page right now. About a year ago, a little bit more than a year ago, the Federal Reserve cut interest rates by 50 basis points. And what we actually saw is the 10-year Treasury go up from about 3.6% all the way up to about 4.5%. So there was a cut in short-term rates, but long-term rates went higher. Why would that be? The market was concerned that a cut in the federal funds rate would bring about even more inflation because the market thought that monetary policy was already easy enough and rates didn't need to be cut. If, on the other hand, the market understood the Federal Reserve cutting interest rates because the economy was slowing down, we would see the 10-year Treasury rate go down. In the most recent round of cuts, the Federal Reserve reduced the Fed funds rate by 25 basis points about a month and change ago. And the 10-year Treasury has gone down a little bit in terms of its overall yield. I would say that it's too early to tell if it's going to stay at this level or if it will migrate back up due to concerns about inflation. The 10-year Treasury serves as the basis for mortgage lending. Some of you out there might recall mortgage rates being at about 3%, and some of you may be waiting for mortgage rates to go back down to 3%. I would say that the 3% mortgage rate was an anomaly. It was an exception that occurred in the wake of the great financial crisis. We've never seen it before. I'm going to go out on a limb and say we're probably never going to see it again. The long-term average mortgage rate's about 7.5%. We're currently looking at mortgage rates for 30-year loans at about 6.4%. So attractive compared to long-term average, but if we look at compared to that 3% window, decade or so in the wake of the great financial crisis, it doesn't look as great. But I'm not holding out hopes that we're going to see that again. S&P 500. Now this is interesting. The long-term average rate of return, when I say long-term, I mean 100 years. Average rate of return on the S&P 500 is 9.75%. Sounds really easy, right? And if we just put our money in the stock market, we get 9.75%, and we double our money every 7.5 years or so. How can you lose? Well, one of the ways you can lose is if you look at this page, you can see that year over year, the S&P 500's yearly return is nowhere near 9.75%. Matter of fact, if I give you a range of 2% lower and 2% higher, in other words, 7.75% all the way up to 11.75%, the yellow lines on this graph show how many times it's been in that 4% window between 11.75% and 7.75%. It's only been 3 times in the last 100 years. So it gives you some idea the volatility that goes with investing in the stock market and why it is so important to focus on long-term averages rather than trying to time the market. And since we're talking about timing the market, The next slide shows the S&P 500. We are sitting at record highs. It is considered, the valuations are considered to be elevated. What do I mean by that? The most popular way to value the S&P 500 is looking at it on a price to earnings basis. Right now it's trading at about 24 times. What that means in simple terms is for every dollar you invest in the S&P 500, if you're waiting for just the corporate earnings as they currently sit to pay you back, it's going to take 24 years. The long-term average PE ratio, to give you some idea of how high valuations are, is 16 to 17 times. So there's a lot of hopes and dreams built into the prospect of corporate earnings rising at a fairly precipitous rate. A lot of people look at valuations and they say, oh, they're elevated, I should probably get out of the market. I want to caution you and say that valuations really aren't a market timing tool. Valuations can remain high for long periods of time. What valuation is better at is telling us about what the vulnerability of the market is going to be when there's some sort of financial weapon of mass destruction that comes along and creates havoc in the market. Last time that was the pandemic. Prior to that, great financial crisis. There were, long-term capital management and the Russian ruble crisis. They happen all the time. Prior to that, it was the tech stock bubble back in the early 2000s. But they happen all the time. We just don't know what they are, right? And so valuations don't tell us when those economic financial weapons of mass destruction occur. What they tell us is how far the stock market might sell off if that unknown event does occur. There's a certain similarity right now leading to these elevated valuations that we saw back in the dot-com era. Simply speaking, anything back in the late 90s, early 2000s that had a dot-com in their name, it attracted tons of money, right? Whether they had revenues, whether they had profits, whether they had profit margins, whether they had sales at all, it attracted a lot of money. There's a little bit of that going on right now in the AI space. It's just that, if you have AI in your name, it seems to attract a lot of money. Now, not every company made it through the dot-com crisis, right? Netscape no longer here, Lucent no longer here, America Online swallowed up by someone else. These were companies back in the day that were $200, $300, $400 billion companies that disappeared. So we're probably going to see similar things in the AI space. Now, I'm not sitting here telling you I can tell which one of them it is because I don't know. But that is one of the things that's leading to a little bit of the frothiness. You might have also heard about the Mag 7. These are the largest companies in the S&P 500. They're the Microsofts, the Nvidias, the Amazons, the Metas of the world out there. Just those 7 companies make up about 34% of the S&P 500. The other 493 make up the rest. To give you some idea of how top-heavy the S&P 500 is right now. In quick conclusion, going through kind of our main topics today, the bond market appears to be mostly fairly valued on the short end. So the Federal Reserve is seeing some pressure to cut interest rates. I think the primary item they're looking at is jobs, since the Fed's 2 goals is maximum employment and stable prices. They're going to be a little nervous about cutting the Fed funds rate to support jobs when they see inflation is currently trading at 2.9% and they see record highs on all these other items out there. So I think there's going to be a lot of discussion at the next Fed meeting whether they should or shouldn't cut interest rates. I think the net result is they're probably going to go down 25 basis points. Why do I think that? Is because it's still within a reasonable range of what we call a neutral rate. So I don't expect it to create too much turmoil in the market. I'm a little less certain as to how the long end of the yield curve is going to respond. We could potentially see the longer term rates, the 10-year rate, which is the basis for mortgage rates, drift a little higher. That'll be yet to be seen, particularly if the government remains closed, right? The longer it remains closed, the more concerning things will be. Stock market, I just finished that topic. Valuations are high. It's not the valuations themselves are not a timing tool, but a vulnerability tool. As long as AI is the theme, it can remain elevated. If we see any cracks at all in credit, in the AI theme, in AI build out, in attaching revenues to AI, right? Because AI globally is spending is about $20 to $30 billion a month to build out the environment that will support AI, but the revenues right now are significantly lagging. And so we're making a bet on those revenues coming in to at least match the capital layout to roll out AI related products. Overall, in the economy, I think the consumer is a little bit marginalized. You've heard me talking about that probably over the last 6, maybe as long as 9 months now. We track consumer credit card default rates. We track auto loan default rates. We just saw a big auto lender file for bankruptcy, Tricolor. So we are seeing some cracks in the consumer market. There's a lot of folks out there that would argue the consumer is still strong. I would say, from where I sit, I would say the strength in the consumer is coming from the higher end wage earners. Maybe the highest, 10-20% or so are still spending fairly strong, where the remaining 80% of us are a little bit more marginalized and a little bit more discerning about what we want to spend our money on. Overall, the economy continues to grow. We're not expecting a decline or a negative GDP post anyway, absent that economic weapon of mass destruction I was talking about. So things seem to be on a pretty good trajectory. Could we go through something that would put some pressure on the stock market? And if we did, what would I see on the horizon there? Probably the main thing I see on the horizon is probably credit. We're starting to see some cracks in various types of credit product, but particularly what we call high yield or junk bonds. But it seems to be, the theme seems to be growing. So if I was concerned about one thing, it would probably be credit. Thank you all. We appreciate your business. I'm wishing you a great day. And I'll check in with you at the beginning of the year for the first quarter update. Thanks again. Have a great day.